Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today is Tech Tuesday, and what a difference a week makes. My first blip looks at the daily charts for the NASDAQ and Philadelphia Semiconductor Index, the SOX. The NASDAQ ended Monday above its 200-day simple moving average at 2437. The NASDAQ tried to trend above the 200-day in May and June, but failed. The NASDAQ has become overbought, and quarterly and annual resistances are 2405 and 2536. The daily chart for the SOX is not yet overbought and is just shy of its 200-day simple moving average at 381.95. The high yesterday was just above my semi-annual pivots at 378.50 and 381.45. Like the NASDAQ, the SOX could not sustain gains above the 200-day in May into June. My second blip shows the rebounds for Apple and Google, but can these gains be sustained? The daily chart for Apple is above the 50-day and 200-day simple moving averages at 171.60 and 164.19, which indicates upside to quarterly and semi-annual risky levels at 180.95 and 192.18. The recent low for Google is 461.90, with the 50-day and 200-day simple moving averages as resistances at 525.50 and 562.91. My third blip tracks the progressions of the 200-day simple moving averages in other key markets. Gold closed below its 200-day on August 5th as the downside leader. This is resistance at 890.4. The euro followed, breaking below its 200-day on August 8th. This resistance is 1.5226. Now we have to look at crude oil, as the 200-day is still support at 109.75. Put into perspective, the 200-day for the Dow is 12,502. This is why I believe that when the market realizes that lower commodity prices is a sign of weaker global economy, the Dow will fail at or below its 200-day. My fourth blip disagrees with numerous calls that financials have bottomed. This is the 9th trip down this road in the past 12 months. August 17, 2007, the Federal Reserve cuts the discount rate by 50 basis points. Financials rebound. September 18, 2007, the Fed cuts the federal funds rate by 50 basis points to 4.75. Financials rebound. October 31st, 2007, the Fed cuts the funds rate by 25 basis points to 4.50. Financials rebound. December 11th, 2007, the Fed cuts the federal funds rate by 25 basis points to 4.25. Financials rebound. January 22nd, 2008, surprise, 75 basis points cut to 350. Financials rebound. January 30th, 2008, the Fed cuts the funds rate by 50 basis points to 3%. Financials rebound. March 18, 2008, the Fed cuts the federal funds rate by 75 basis points to 2.25. This followed the expansion of the Fed lending facilities and the J.P. Morgan buyout of Bear Stearns. Financials rebound. April 20th, 2008, the Fed cuts the funds rate to 2%. Financials rebound. July 15th, 2008, new lows for financials at levels not seen for some banks since the early 1990s. Financials were extremely oversold, and this has been the strongest rebound. This is not a surprise, but not the bottom. With warnings from Fannie and Freddie, it's hard to imagine that the great credit crunch is over. 3 months ago, the FDIC quarterly banking profile for Q1 provided a wake-up call. The quarterly banking profile for Q2 is released on August 26, and I do not see any reasons for optimism. If you have any comments or questions, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.